Welcome to today's webinar, compiled and produced by the team at biznews.com. All of our webinars are interactive. We encourage you to pose questions to our guests. The more challenging, the better. And the earlier you get the questions in, the better the chance of having them answered. The recording of this webinar will be available later today on the biznews.com channel on YouTube. Yeah, there we go. We've given you all the introduction, all the information that you need, excepting we need to be sure that everybody can actually hear us. My colleague Stuart Lohman always does those duties. Stu, do you want to tell us how, or just to make sure everybody actually can hear us, and secondly, how they can pose questions?
Excellent, thanks, Alec. Always good to be here, Monday noontime. If just on the control panel on the right-hand side, for those listening, if you can hear my voice, see Alec's face in the presentation underneath, can you give us a little high five? There should be I've got one high five, hopefully a few more just to confirm that. There we go, Alec, we've got them coming through now. That's great. As Alec mentioned, there is a little questions bar on the control panel as well. It's got a little question mark. You can put your questions in there, Alec, and pass them on to the relevant panelists. But have fun, Alec.
Thanks, Stu. Okay, David and Peter Major. David, as always, David Shapiro and Peter Major are joining us today because we're talking not really gold. I thought for a while it'll be all about gold. And then when I did my research into Sibanye, which used to be called Sibanye Gold, I discovered that it's not really a gold company anymore. It's very much a platinum or PGM company. But Neal Froneman will tell us all about that. Of course, that's no news to you, Peter. You've been in this industry, in this sector, in mining, ever since you came out of the Montana School of Mines. How long ago was that?
Geez, I think Dave Shapiro was still in nappies back then. Huh? Back in '81.
20, huh? Oh, Peter, good to have you on the noontime webinar. Before we ask Neal Froneman to start answering the questions and giving us some insights to what has been a spectacular story, the past week on the Johannesburg Stock Exchange has been less spectacular, specifically today, where we saw the announcement all over the front page of Business Day that Afrox is to be delisted. Now, in a way, it's not that surprising because Linda, which is a multinational, has owned Afrox for a few years and it's now buying back the shares it doesn't own because they're probably very cheap. But it does shine a spotlight on something that's a lot more significant, and that is the departure of companies from the Johannesburg Stock Exchange. Dave?
Yeah, it's Afrox has been around a long time. You know, in the 1980s, 1990s, it was one of the top industrial companies on the JSE, simply because of the companies that it serviced. I mean, it produces gas. So for welding, I'm not an engineer, I'm an accountant. I think you understand every company from hospitality to manufacturing needs gas. And they were, you know, top award-winning business, not only for the profitability of the business, but also the accounts that they used to produce. So it was a very big company in our lives. And I think the way that the economy has gone has just, you know, taken this out of our radar, or off our radar, together with so many other companies that I can mention. You know, if you look at ArcelorMittal today, if you look at Nampak, if you look at Reunert, if you look at all these businesses that were associated or aligned to where our economy was, they've all shrunk considerably in size. So it's not surprising that we're seeing this trend, Alec.
There was a wonderful graph, well, not such a wonderful graph, but a graph that I reproduced in my newsletter to premium subscribers this morning from Kevin Lings, which shows industrial or manufacturing production in South Africa versus emerging markets. And I'm going to try and find that graph to reproduce here, because it really is scary how far we've gone backwards relative to the rest of the world since 2006. But just to go onto the JSE itself, Peter, in your time, you would have seen, well, in my time, I've seen Leslie, Kinross, Bracken, lots of fun shares on the gold board, but many other mining companies. Eersteling, remember, and you look at the mining board today, take away Sibanye, Goldfields, and Harmony, and wow, you have to scratch.
It's devastating, Alec, and devastating is an understatement. You know, we've gone from having 62 listed gold shares to what? I don't think we have 10 now. We've gone from having 110 to 120 listed mining shares. I think at one time, I heard this stat bandied about, we had more listed coal mines than the rest of the world put together. I don't know if that was true, but I think at one time we had 12, 14 listed coal mines. And this country still has more minerals than America and Russia put together. And we haven't mined them out, but our policies and regulations, as the international financial community tells us, until we have policy changes, we will not get the investment we need to get this country going. That mining, I really think we bore the worst brunt of it. All these delistings, I cry for every one of them, and none of them were necessary.
Is there any sign of a turnaround on that front?
No, not on that front, because if you look at the reasons for those delistings, it's massive regulations. We were talking earlier, God gave the world 10 commandments and Gwede Montash gave us 2,000. 2,000 new regulations in mining and 3,000 policy changes. And even if we didn't have that, just the fact that the MPRDA says you now have to give away 30%, and it's just not attractive. There's 200 countries in the world to invest in. This is the least attractive one, even though we've got all the minerals. And then if you add on Eskom, if you add on a breakdown of law and order, of zamas hitting you left, right, and center all the time, I'll admit we can't blame the unions very much anymore, and we can't blame the communities too much anymore, but they did play very big roles on destroying a very attractive mining environment, destroying an attractive investment environment. So a lot needs to be done, starting with policy changes to change that.
David, you always look for the bright side. Is there any here?
Probably it can't get worse. I don't know what to say. You know, I always listen to Peter. I listen to Neal, and I think you've got two incredibly honest and forthright guests who tell it like it is. And you know, what Peter says, and I think we'll hear from Neal as well, is that there is an array of minerals here and metals that no other country has got. You know, when Peter said he joined in 1981, I joined in 1972. He qualified, said, I joined the stock market having qualified already in 72. And, you know, you started to list those gold mines. You want me to continue? I'll keep going, Alec. You know, of the President Brands, President Staines, Western Holdings, South Vault, you keep going. And these
Vaal Reefs, Western Areas, Randfontein Estate.
Yeah, but what we don't understand, for anybody who's looked at the South African economy, was the ancillary industries around mining. And that's brought us this incredible industrial power. You know, that's where we got the ArcelorMittal, or what was Iscor, and all the different industries around it. Now, every time you close down a mine, you close down an ecosystem, a whole industry around that mine. So when you put up a mine, it's the opposite. It just, you know, it creates so much economic activity. So I think that's what I miss. And I know all the Anglo companies, you know, from the Score metals that were associated to mining. So, you know, it's sad. Every time a mine goes, it's not only the miners that go, it's the whole ecosystem around it as well.
But getting back to the JSE and investable opportunities, I had a terrific interview this morning with Gerrie Fourie, talking to him about the deal they've done with Cappy Tech and Easy Equities. And he was saying to me it would be no surprise to him if this deal were to create 1 million new investors on the JSE through easy equities. You can go in there, as we spoke on this program a few weeks ago with Charles Savage. You can put 100 Rand and invest in Sibanya. You don't have to buy one whole share. You can buy a fraction of it. Who, with this kind of a new shareholder base coming in, isn't that one of the reasons why we should start getting maybe more listings or maybe more interest or maybe more pressure on a government that really battles to embrace capitalism?
Alec, if I can put in 2 cents here. This delisting hasn't just happened in South Africa. It's been a phenomenon that's gone on for a couple of decades now in America. And it's also because of regulations and reporting. And I always thought government should use the fact that when you had listed companies, it was so easy to know what was going on. It was so easy for a government to formulate policy because they could easily see what were the pluses and minuses, what were the impediments to growth, what were the incentives to growth. But when you have delisted companies, who really knows what's going on? You know, some of the auditors do. And I always thought government should actually, okay, Major always starts out, government should force all companies over a certain size to list. But how about making it attractive for them to list? How about saying listed companies won't have to go through some of these obstacles that they currently have to go through? In fact, we will make it even easier that if a company lists, we'll remove a lot of obstacles that unlimited company has to adhere to, because it is so much better when you had all these big companies that reporting everything, and you had all these good analysts writing on it. Government just had to buy an analyst stock market report, and they could learn about the whole mining industry, the whole gold industry. But it's these regulations, not just here, but worldwide, that are making it more attractive to delist than to stay listed. And that's a huge loss to everybody, especially investors.
Alec,
And as promised, there's the graph from Kevin Lings from Stan Lib. Doesn't that just tell you everything?
This could be a mining industry graph here. You're right. The rest of the world is producing more gold mines every day, every month, every year as the price goes up. And we are impervious to the gold price. We just continue to retrench, close shafts, retrench, close shafts. Yeah, very important graph here.
Alec, there's one element I want to bring up, just which angers me, having been on the market and still on the market, is that when the stock exchange motto used to be own a share of South Africa. In other words, own a share. It used to encourage private individuals to come in and own a share. And when I started, there was no such thing as a unit trust or an ETF, and I'm not criticizing them in any way at all, but there was a culture of wanting to own part of South Africa. We've moved away from that. Today, we're much more interested in derivatives, in high frequency trading, in all the issues that create more turnover on the market, rather than what the stock exchange was there for, to allow private or smaller companies to raise capital. We would not have survived. We would never have been where we are without a stock exchange, which goes back to the gold JSE goes back to 1886, which allowed money to be raised to actually dig the holes in the ground and to mine out the reefs. And I still think there's a move for easy equities to survive, and to do that, we've got to go back to that culture of wanting people to own a share of South Africa. It might be old-fashioned, but we've moved so far away from that.
Well, I think that it's always darkest before the dawn, first point. And second point, there's some big moves on that side, with easy equities charging 0.2% brokerage, and also this deal now with Cappy Tech. And I'll tell you something, guys, before we bring Neal in. I opened an account for Jeanette this morning. She's a Cappy Tech bank account holder, as am I. I do my expensive stuff at Investec, and Cappy Tech is actually the one that I should be using more of. It was literally a 5-minute story, because you're already KYC, because you're a Cappy Tech shareholder. You go into the new app, you click on, there were 2 clicks, open the account, and she's dying to buy her first shares. And maybe one of them is going to be Sibanya. And as it goes forward, if you've got, Gerry was saying, or there already what was Charles Savage telling us? 380,000 already account holders. Harry says add another 1 million to that. You know, you're starting to talk about a shareholder culture potentially that could be coming back to South Africa, and you are the kind of guys that'll be rock stars in that environment. But so is Neal Froneman, a rock star in an environment for any shareholder. Neal, if we can just switch your webcam on, and there we go. I know you can certainly hear me. There we go. David, you don't have to leave. You can greet Neal, as I will now. Lovely to see you.
I have to ask Neal this thing that's been bothering me, Alec, if I can ask him. Why are you in Florida? I've been searching every company that you own to find out where the offices are in Florida. I know Weltevreden Park, but Florida.
Okay.
I'm looking to start a mine in Florida, so I'm looking very hard. But David, I have a house here, and actually got stranded here as the COVID pandemic broke out. We were doing some marketing in the US. We had just relisted Sibanye Stillwater on the New York Stock Exchange. We were planning to have some meetings in Washington, and everything got closed down. It does seem strange. We do have operations in the US, but listen, whether you are locked down in South Africa or as I am in Florida, it's the same thing. You're working virtually, and it's taught us a lot. And there's a lot of good opportunities that have arisen due to this. And
those headgears behind you, Neal?
Funny enough, that's from a Harmony calendar of the mid-90s, and I had them framed. Yeah, there's a few more lying around my offices. So yeah, it brings back very good memories. I learned a lot at Harmony.
A proud history as well of South African mining, and you've been in it for 30 years. I actually, in one of my newsletters, was it this morning? Anyway, it felt like very recently. I recall the trip we had in your helicopter where you took me around the Wits Basin and showed me the geology, and you know, you still got a passion for that side of it, Neal.
Absolutely. I think I love what I do. It's not a hardship. I turned 61 a few weeks back. I would continue working until somebody tells me I'm not adding any value. I love mining. I'm distraught about our country. I think Peter sums it up spot on. We can talk more about that. I still fly. I don't fly enough because in the US it's quite difficult. I'm trying to get my American license, but in terms of my job, I love it.
Peter, we can start off with you posing the first question, but I just wanted to put this on the screen to remind people why Neal is with us today. When Sibanye was created in 2013, you became the very first CEO. And the market capitalization, you can tell us exactly what it was, but it was hardly into double figures in billions. Today, it's 150 billion rand. Do you have people who come to your AGMs or maybe who email you like Warren Buffett does, and you know, they knock on his door and they tell him at the AGM he's transformed their lives, changed their address? Do you have people who came in the early days and have stayed with you?
Yes. I have or I should say we, because we're a team at Sibanye Stillwater. We have a really good following, and we have many people that when we do meet with them and do some marketing, are really very happy shareholders and back us in what we're doing. You know, when I look at that graph, it's awesome, but we went through some tough times. Some very tough times, but we got our strategy exactly right, and hopefully we can do more of that.
Peter, first question.
Well, first question is, Alec Hogg didn't work at Allen Gray, because if you show a linear graph instead of a log graph, you're on notice that you'll get fired. Second of all, a market cap graph means something to some people, but it doesn't to an investor. an investor wants to see what his share price has done, but a market cap does mean a lot to a country because it shows how this company has grown. And in a country, they're not being mean. They don't always care about the share price. They don't even care about the return if the company is growing. So in Neal's case, he's lucky. He's rewarded both sets of people. I think he's rewarded the countries that house this company, which is the United States and South Africa. Because when I look at the origins of this company, it was pretty much, I don't want to say it was leftovers, but it was a lot of shafts and mines that literally were going to be orphaned very soon. And boy, not many orphans have this kind of future. So I think Neal did a great job putting orphans and fire sale companies together. Just look at Lawnmen and the others. And he's made it into this 120 billion, 130 billion Titan. And we're not looking at the share price graph, but it's just about as good. I think when this company was first created, Neal, it was about 140 US cents, and I think it's now about 310. So that's 10% a year in dollar terms. Even the S&P hasn't done 10% in dollar terms. So you're lucky, you're straddling both sides, and you've made both sides very happy.
But the point of putting the market cap on there, though, Neal, from my perspective, was when you first went into Sibanye and you took that job as a CEO, you'd already had a lengthy career in mining. Was this going to be the strategy that you would be scooping up South African gold mines and then looking at PGMs, which is exactly what you've done, and transforming a very small company, relatively speaking, into this giant?
It was exactly the strategy, and maybe I can just recap a little bit. I've always tried to build a proudly South African mining company, a new proudly South African mining company, and I did that out of very small companies. You would remember New Kleinfontein was acquired by Athletes, which became Gold One. Uranium One came out of that, but we always started off a small base. And when I became aware that Gold Fields was going to unbundle these non-core assets, it was a much bigger base than I'd ever had before to do something. I volunteered. I put up my hand, approached Nick Holland. Nick approached his board. I went to my board. Told them about the opportunity, and they released me to actually do this. And off this base, a couple of unique things happened. First of all, I was given the opportunity to put a board together with a clean sheet, and the way I did that is I already had a broad strategy in mind, and it was really about creating an industry-leading dividend payer. Using a bit of our Chinese relationships initially, but then using an industry-leading dividend payer as a basis to diversify the company, so that you didn't get stuck as a gold company only. But in doing that, I was able to approach each potential non-executive director, share with them the strategy. So by the time they joined the board, they either joined because they supported the strategy or they didn't join at all. All of them joined, by the way, but that allowed us to have a company that had an aligned board. We could move very quickly. They still kept us in check, and we had to do the work. And off those very early concepts, we were able to do what you see today. And you know, it was a little bit about we recognized the PGM industry was depressed. We had good insight into the future. Barry Davison was one of our non-executive directors. He had been with me on the board at Gold One, knew the PGM industry backwards. We did the work, he guided us, and so it went. And we were able to move very quickly and do it in a very cost-effective way. And what you see today is the end result of that.
This is my my coggle, as we call it. It's the mind map that I put together before every interview, and you can see in that spot there on the right-hand side, or I hope you can, where it talks about acquisitions. There's a whole long list of them. First of all, this was after the creation of Sibanye, Cook operations from Gold One, then Burnstone from Witsgold, and then you went into platinum only in 2016. But the result of that has been massively transformative. Not just platinum operations here, but when you bought Stillwater, and that acquisition, that $2.2 billion deal for Stillwater, mostly funded by loans or by debt, had many people scratching their heads and wondering whether Froneman had actually lost it. Did you ever feel at some point in time that it was one too many risks?
Alec, you sum it up so well. We knew we were buying a tier one asset. It has a very checkered history. Has had some, some significant downs as an asset, but the basic asset quality is first class. The fact that we took on debt, we knew we were taking on a lot of risk. And if I'm critical of what we did, we should have done more to manage that particular risk, because a year later we had significant safety issues, and in today's quite rightly so climate of very high ESG standards, it nearly put us out of business. But that was a risk we did not envisage, and as I say, we should have done more to manage the exceptionally high debt burden that we took on. But investors punished us because they didn't understand the asset. Today, of course, it's a different story. The Stillwater asset's probably worth 70-80% of our current market capitalization, and it's made us a PGM. Well, our PGM business probably has the best geographical diversity of any PGM company in the world. But we took a lot of pain doing that transaction, and we had to do it with cash. You couldn't do it with equity. It would have been value destructive if we had tried to do it using our own equity.
David, don't you like this? I pulled this out of the interim results. It's a PGM company now, really, in a large degree.
Alec, what's remarkable is the transition, because Neal seems to have been around forever. And yet when you look at or Sibanya, and yet it's only 2014 or 2013 that he started. And in those early days, I recall you were getting dividend yields 5.5%, 6%, thereabouts for a couple of years. And then once the Stillwater deal was done, that was the end, and subsequent to that, I think all the cash has been redirected. Neal, where to from here? And there's a question I want to ask is, where's the next move? And how come you managed to pick up the Stillwater asset? Was it that being South Africa, you understood PGMs more so than any other, besides the Russians, any other country in the world? Because it's certainly paid off. And there's just one other leg that I found very encouraging, is that there were 6.9 million motor vehicles sold in September, which takes us back to December 2019. In fact, the average. It seems that motor vehicles are back again, and you would have known, globally, motor vehicle companies have been going up as well as platinum companies. So how do you see the industry, and also, what gave you the insight into going into Stillwater, which is somewhere up in Dakota, which is not really South African climate, it's not really for a South African boykie.
Yeah. David, let me just pick up a few of your points there, and I'll try and answer all of them. First of all, you heard me say earlier that we positioned the company as an industry-leading dividend payer, and certainly in the gold sector, a 5% dividend yield was unheard of. The Barricks and the Newmonts, if they were paying dividends, it was perhaps 1%. Listen, it does suggest that our share price was lower, and of course that's part of the problem. It's it's a vicious circle. As you re-rate, of course, your yield goes down. But nevertheless, we did have to stop our dividends, and that was another learning is that we lost a lot of support stopping our dividends. And going forward, and I'll answer that part in more detail slightly later, but going forward, we need to make sure that we don't stop and start dividends even for something like a Stillwater transaction. But we had no option, especially with the tough period we went through in 2018. We had to conserve all our cash. The reason we got our PGM entry right is we did the work, and we started talking about PGMs publicly in 2014 already, and only made our first move in 2016. And the board kept our feet to the fire. We had to do significant analysis on supply and demand, and we got to understand and build very, very good models that have served us well. So the bulk of understanding demand is understanding the global car pool and how that's going to evolve. And essentially, it's only pure battery electric vehicles that do not use PGMs. But what we realized in 2016 was that palladium was moving into very significant deficits. And it was mainly because diesel vehicles, which predominantly use platinum, had become unpopular. And the whole world was shifting to gasoline engines, which meant that palladium was coming into vogue. And when you look at who are palladium producers, there's only one primary palladium producer in the world, and it's Stillwater. Funny enough, when I was at Harmony, I was actually offered the chief operating officer's job at Stillwater, so I knew the mine. I never attended an interview, but I researched the mine, and I always remember them as being a high quality palladium mine. So when we took our demand analysis and then started looking at where is the best opportunity to get exposure to palladium, and Stillwater, 78% of the prill split is palladium, it was a very obvious choice. And at the same time, it was the Zwane era, and it was clear to me that we had to diversify risk geographically as well. And there was just no one interested in PGMs. I mean, we picked up the Rustenburg assets from Anglo Platinum by paying for them out of future profits. So it really didn't cost us anything. The Aquarius transaction was a vanilla type transaction where we paid a market related premium plus, on top of their market cap, and got that done because we needed a management team. Stillwater, we had no competition. The Stillwater management tried to get Rio interested. There were some other companies as well, but we had the bit between our teeth. We had a very good feeling about our model, and in fact, Stillwater was going to be the fourth step in our strategy, and we moved it to the third step because we could also see Lonmin going into financial difficulties, and we thought we could buy cheaper, which we did. But Stillwater was really based on getting exposure to palladium. We bought it at $700 an ounce palladium. Today, palladium's over $2,000 an ounce. And of course, you don't get you get a lot of gearing when you look at the bottom line in terms of, increases in commodity prices. So it was a brilliant acquisition, really it was.
Peter, I've put this up on the screen appropriately, I think, because it can be a bit of a follow-up from your side to Neal's question. But look at that, palladium up 138% in the last 3 years. This is from your presentation, Neal, so I hope you got the numbers right. And then platinum has actually gone down in that period, which is interesting, Peter. Anyway, your question. Apologies. Peter, if you just hold on 1 second, we'll unmute you. There we go. Okay. No, I think you're going to have to unmute on your side, Peter. There's a little microphone button. There we go.
Does that work?
You got it.
It's not really a platinum company. It produces a lot more revenue from gold than it does from platinum. It produces a lot more revenue from palladium. In fact, if I just look at the PGMs of this company, I think it's 40% revenue comes from rhodium, 30% comes from palladium, 20% comes from platinum. And then when you bring in the gold side, so platinum, I don't know, Neil, but I'll bet platinum is about 10% of your revenue, maybe 13. And hey, that's the nice thing about having a diversified revenue stream as opposed to a single revenue stream, like a coal mine. And our coal mines learned decades ago. Let's diversify. Let's have a ESCOM component. Let's have a local component. Let's have an export component. And I think that was the best part of the strategy here. He inherited some good mines, gold mines, but to diversify into platinum. Warren Buffett always says it's the only free lunch he's ever seen is good diversification. And boy, you've got it. The platinum miners had a really diverse source of revenue. So the fact that platinum has totally bombed out is almost irrelevant because the other components have done so well.
Yeah, no, absolutely, Peter. And I must tell you, in terms of the medium to long term, I'm most bullish on platinum, funny enough. But for now, rhodium and palladium are significant revenue earners for us. Platinum is going to benefit from the hydrogen economy, the growth of fuel cells, and I know you and David and Alec would have heard fuel cells for the last 20 years, but they are now separate line items in terms of the demand. They do feature a lot in China already in heavy duty vehicles. And COVID has recently raised the visibility of environmental issues again, and countries, especially in Europe, are providing incentives specifically driven at battery electric vehicles, but it's still an environmental subsidy that is being driven, which highlights the environmental aspects. So in the long term, platinum will prosper. Platinum has actually got the longest legs of all the PGMs. Rhodium and palladium, we understand. Rhodium will continue to also feature. Palladium will probably wane slightly in about 2027, and that's when internal combustion engines will start becoming less of a mix. So we probably also have the best combination of PGMs. We're a 50-50 platinum palladium company. Most South African companies are predominantly platinum companies, although they now try and be palladium companies. But if you add up our overall combination of metals, 50-50 is platinum palladium. We're the biggest rhodium producer in the world as well, by the way, and that's the most precious of all the metals. We're also the biggest in the world in iridium and ruthenium. And just to complete that, we're number 1 in platinum, number 2 in palladium, with Norilsk nickel being the biggest palladium producer, but it's a byproduct. We're the biggest primary producer of palladium.
I was interested to see, going through the numbers, Neal, that your gearing is now back to where it was before you did that $2.2 billion acquisition. So, wow, the timing was exceptional. David, we've got a number of questions from the community, but before I go to those, your next one?
A very simple question. What's happened to the platinum jewelry industry? And I say this as an old timer, and Peter will understand, before we had the auto catalyst or before they were so prominent, demand for platinum from the East was very, very high and was an important part of the demand curve for platinum. Is there still some, especially in the age of luxury, does platinum jewelry still exist?
David, it does. And we all remember the jewelry component being the shock absorber in the market. That's how it was positioned. Having come into this industry recently, we come in without any preconceived views. Barry Davison was, was really, let's say, a real promoter of what happened in the 80s and the 90s. But we've actually seen changes in the market. For instance, in the East, consumers would rather buy a high quality mobile phone than they would a platinum bar, even if it's cheap. And we don't see the jewelry market as being the shock absorber anymore of the PGM industry. In fact, although we support the Platinum Guild, which is the jewelry component of the market development for the industry, we've actually recognized that substitution of palladium with platinum is actually going to drive bigger demand than jewelry, and we've been sponsoring research with BASF to improve the demand for platinum, but also to make sure that we bring the whole industry into balance. So the jewelry aspects have changed, and it's a change in consumer tastes, and hopefully, we've called it right, and that's coming in without any preconceived ideas. I just wanted to add one more thing on to the diversification that was mentioned earlier. We love the combination of gold and PGMs. We're not exiting gold. I want to make that very clear. In fact, the next thing we would like to do is improve our exposure to gold and probably even battery metals, because we see them complementary to PGMs. But gold and PGMs are almost a natural hedge of each other. In uncertain times, gold will prosper, and you want gold because invariably there's an economic issue, and in the PGMs are industrial metals, and they will suffer poor economic conditions. And the flip side is normally true. At the moment, we're benefiting both from good gold prices and good PGM basket prices, but the combination is unique. And a lot of the good comments we get from people that understand this business is that we're the only precious metals company that is a top 10 gold producer and a top PGM producer. That's a very unique combination of commodities in one company.
David Melville is one of your big fans, as you well know, Neal. He's just dropped a little note in here. He says, well done on your excellent growth of Sibanye. Will you be able to buy South African gold assets, or would you be looking to develop or get gold assets elsewhere as you did with Gold One?
Yes, I'm deeply disillusioned with South Africa, so investing more in South Africa is very difficult. I've been quoted as saying you can't speculate with shareholders' money. It's very sad for me as a South African to say that, but there are better places to invest shareholders' money in the mineral sector than in South Africa. So country risks are one issue, but the other problem in South Africa is that you don't want ultra deep level gold mining exposure. It does not sit well with ESG focused funds. The safety risks are significant, and certainly if we were to build our gold business, it cannot be in the ultra deep level space, but also, of course, South African the South African investment climate is also not a great one at the moment.
I've got to follow up that one and ask you, what would change your mind on that front?
Alec, we need some significant leadership. I think I've seen the recent plan. I've been part of business in terms of trying to convince government to do the right things. I remain completely concerned, and the current plan that's been put out is all endogenous. In other words, everything is within South Africa. There is nothing that addresses the external perception and creates an environment where external investors will bring money. It's all driven by us spending. And I don't believe we can spend. I believe we're bankrupt. It's just a matter of time before we as a country hit the wall. So what is needed? Well, some very, very tough decisions. For instance, investment-friendly decisions. This, the commentary about expropriation without compensation, that just does not fly anywhere in the world, except in countries like this. It's wrong. It's absolutely wrong. Maybe there's some different words that can be used, but the fact that government continues to use words like that, and yes, I understand the historical legacies, and I'm not saying they don't have to be addressed, but when you use words like that, that is not investor friendly. If you talk policy certainty within the mining sector, there's a lack of certainty. We have court cases. Those court cases have to continue. You know, government will say, well, drop the court cases, then you'll get regulatory certainty. No, we won't. We will look after our shareholders, and we will take it all the way to the constitutional court if we need to. You can't change rules looking retrospectively. So again, that is something that needs to change. When you start talking about prescribed assets, all of those things are not investor friendly. Then you couple that with the operating environment and the fact that we have to take on many responsibilities that are actually the government's responsibilities. We have organized labor that does not act within the national interest. I can go on and on and on. Now, having said that, I must tell you, I still think that we can make a lot of money by operating in South Africa, but it's tough and it's not conducive to building up a shareholder base and a share premium in terms of your equity. So it is a tough place to operate, but there's a need for some really tough decisions and corruption to be dealt with properly. Not, what we're seeing is tokenism. And to some extent as business, we're being humoured. It's time for business to start taking a very transactional approach. If you don't do this, we will not invest in that. If you do this, we will support you and invest. Because we just talk around the issues, we never really deal with the issues when we engage directly with governments. I'm very, very, very disappointed. At least we have somewhat honest government. We have a minister we can talk to, which we didn't have with Zwane. Gwede is a great guy. He's a great guy, and he understands the industry, but the ideology of many of these government ministers is not conducive to capitalism.
Peter, your call.
Well, Neal says everything I'm writing down. And we know our president's under a lot of pressure. Cabinet's under pressure to deliver. We got 40% unemployment. We got negative growth. But we've got to say, how did it get there? They didn't inherit that. They didn't inherit negative growth. They inherited the world's richest mining country. They inherited hundreds of billions of capital investment, not just by private industry, but by the government. So if we started with all this, how did we get here? And I think you read it every day in the paper. Policies. Policy, that's your roadmap. You're driving a car, you're going to Joburg or wherever else. Your policy is your roadmap, how you get there. And we have investor unfriendly policies. We have operationally very difficult policies. So I think you asked Mr. Shapiro here a little bit ago, are there any good sides to the story? And I agree with him. Yeah, it almost can't get worse. That is true. And that is a big plus. Hey, if you're on a slide going down and you can see it's going to get a lot worse, that's not a plus. But if you say it really can't get much lower, that 40% unemployment is crazy, and every survey I've seen, whether it's by a newspaper or the Human Resource Council, every survey I've ever seen in this country, what's your number one concern? It's jobs. What's your number two concern? It's family, where it's, you know, you never see land in the top 10. You never see all these purported priorities that government says they're doing these crazy things for. Every time they interview somebody, it's jobs. Well, we are at the bottom. It will be so easy to create jobs. You create an investor-friendly atmosphere here. The world has never been awash in cash like it is now. Trillions are being created out of thin air. And you'd think if we got rid of this force field we've put over this country, a lot of that money would come in accidentally. Then just don't get rid of the force field. Actually gear your policies to attract, like a magnet, like a vacuum, suck in that money. And it would be so easy to turn this country around, I think.
Nice stuff there, Peter. Just from your perspective, Neal, and there are a lot of people who are talking about getting more active in changing this government, and that the ANC is too corrupt and too rotten to ever put the national interest first. That's the view. I'm not saying which side of the fence I'm on, but if that were to happen, let's just say by some miracle, because it looks like it at the moment, you were to have a very different approach, rather than a socialistic approach towards the economy, a capitalistic approach to the economy. Do you think that Peter's right, that you would see money flooding into it?
Absolutely. You know, when you listed some of the transactions earlier on that we had done, Alec, we have two projects that are world class. Burnstone, we stopped when we had to conserve money. It's half built. We have K4 at Lonman, is probably the best PGM project that in the world. It's a brownfields expansion. The shafts are sunk. We would press those buttons tomorrow. We've updated the feasibility studies. You know, they worked at half the basket prices that we're seeing now, both in terms of gold and PGMs. I would love to announce those, but I'm damned if we're going to do those when in the current environment. And I know that many of my colleagues think the same. They don't say it. I say it. Because I want government to change and create an environment, and business will do the rest. But there needs to be an acknowledgement that business is part of the solution and not part of the problem, and allow us to get on, and we will do it in a way that creates superior value for all stakeholders. So I agree. There's investment is on strike. I tell that to Gwedi. I've told him, I've written that to him. Because that he understands, investments on strike, and it's going to remain on strike in the mineral sector. Only investment that is absolutely necessary to survive is going to happen. But additional investment in terms of growth and enhancement, I do not believe is going to be happen, because you can't justify it to your board. You can't justify it to your shareholders. There's too many unknowns. There's too many risks.
It doesn't seem like it's rocket science. It's there are solutions to it. Just before David poses his question, you recently bought a company that investigates different futures and demands for instance, battery, the products that go into batteries. How are you seeing this treasure chest or mineral treasure chest in South Africa being positioned? Let's say all things being equal. Let's just have a fantasy for a minute and say government changes, we get a very friendly, investor-friendly government. Does South Africa have the minerals which will be in demand for the new age of electric cars and so on?
We have many of them, Alec, and just to complete the picture, we acquired a company called SFA Oxford, and SFA Oxford are well known as analysts or researchers on predominantly PGMs, but they have built up, as part of that knowledge base, a very good understanding of the electric powertrains of the future, and of course electric powertrains are ultimately going to be driven by hybrid engines. That's a combination of internal combustion engines and generators. They're going to be driven by fuel cells and pure batteries. And it's the pure batteries that we did not understand a lot about. And pure batteries can be made up in various different ways with different metals. You know, lithium, cobalt, manganese, nickel, and of course, common to all of that is copper. And yes, many of those minerals are we well endowed within South Africa. And despite my negativity about the country, we continue to do work and look at opportunities in South Africa, and we'll continue to do that because things can change very quickly, and we don't want to, you know, be on the back foot when that change comes, if it does come. So there are lots of opportunities. As Peter said right in the beginning, we're a country that is so well endowed, and you know, you might see slight improvements in the Fraser Institute ratings and so on, but it can be so much better. And yes, there's lots of those metals in South Africa as well.
David, your last question.
You know, I think, Alec, I think you got your answer to the very first question, is why there's so many delistings. I think you got it very clear. You know, until we roll out a red carpet and go to investors and say, you know, what can we do for you? I think this is going to persist. But the question to Neal is there anybody doing it right around us in our neighborhood? I'm talking in the countries around us. Because, I mean, we bless sub-Saharan Africa with an incredible array of minerals, as we've seen historically. Is there anybody doing it correctly, going in the right direction?
Yeah. The one shining example is Botswana. They did it extremely well. They've fallen on hard times because of diamonds and the depressed market. But if you look at you know, countries like the Congo and Tanzania, Zambia, they're not doing it right, and you see exactly what's happening. They prevent Glencore from putting a mine on care and maintenance because it's uneconomical. There are taxes withheld in the DRC. You know, in Tanzania, you had the whole fallout around acacia and taxes. You know, to me, Africa needs to be taught a lesson. You can't do that to people that take their hard-earned cash and invest it into projects that you can't move. You know, at the same time, and it seems like I'm pointing fingers always at government, which I am, but the industry is also you know, at fault. We've been very focused as an industry on just shareholder returns. You can't do that either anymore. You have to look at what we call you know, creating value for all stakeholders, because they are natural resources and communities, and you know, the citizens of a country have to benefit from it. We understand that, but it doesn't make it right that you always treat the investor the wrong way and put the investors at risk. So in Africa, Botswana is a good example. Ghana is another one. Of course, that's why you get a premium, you know, in a mining company in Australia or in North America, because they don't do that.
Just the final question on your side, Peter, and I'd love you to just dwell a little bit on this chart, because I think it talks to a lot of what was said before. This again comes from the Sibanya presentation. It shows the different ratings between companies or mining companies and Sibanya, which has still got a huge exposure to South Africa. Neal, maybe you can take us through it, and I'm sure that Peter will have some thoughts.
Yeah, certainly, Alec. And I think if you look maybe just at a little bit of our recent history, we've only recently deleveraged. So we've come out of a very risky period, and I'm often asked why we are undervalued. And I have to say, I actually know why we're undervalued, but I also know now why we are going to re-rate. And our net debt to EBITDA has come down from just over 3 times to at mid-year to 0.55. We've just exercised the soft convert, which takes our net debt to EBITDA down to 0.2 and perhaps even lower. So we are actually now deleveraged, and that's only something that's literally happened in the last few months. While you have an overhang such as risk on a share price, you will be undervalued, and this is what this shows. Now, listen, some of it is South Africa, but the bulk of it in this case is really the high leverage that we had due to the very high debt. What it should tell an investor, though, is if you factor in the fact that the risk has largely been dealt with, then there's no reason why we shouldn't possibly, in terms of multiples, and there's a number of analysis here, EV to EBITDA, price to free cash flow, and of course EV to market cap. There is absolutely no reason why the company shouldn't see a substantial improvement in its valuation, which really means its share price should go up, and that's what this analysis shows you.
Peter?
Look, it's all about rating. If you get a higher rating, you can raise cash much easier, much cheaper. You can expand quicker. You can pick up competitors. You can pick up opportunities better. With a low rating, you're always taking big risks. You're always paying way more. And look, I don't know how religious Neal is, but everything went in his favor in the end. But they did take a big risk, borrowing all that money to get Stillwater. What if the world had proceeded differently? What if these PGMs didn't explode? What if the US market would have collapsed and interest rates went up? And anyways, it didn't happen. So I think my big question is, how do we lock in these tremendous gains? And how do we keep the company going forward and turn it into a bit of a less cyclical company? And I'm not an IT guy, but you read what the IT companies are doing, Google and Facebook, and that's exactly what they're doing, like the mining companies. They're looking for opportunities. They're looking for lawn mins. Sometimes they overpaid for certain acquisitions like Twitter and WhatsApp. Sometimes they got them at a steal, and sometimes they just neutralized the competitor, but the idea was to help grow the parent company. So as Neal said, he's got a wonderful balance sheet now, and he's a fund manager now. He can raise a lot of money on this balance sheet, and he can improve his rating, but he needs to make sure every investment gives him a higher PE, not a lower one. And we know South Africa is not going to give you a higher PE rating, even though you can get the assets cheap. So they're going to have to generate a lot of cash quickly to justify putting the money here. And I think it's time to have serious negotiations with the government, Neal. I'm sure you already are, but you just read the history of Oppenheimer's and many of the other magnates then. When they wanted to sink these deep level shafts, they went to the government and said, we've got the expertise, we got the capital and desire, this country's got the goal, but we need your buy-in, we need your help. We need a tax-free holiday and to justify 10-year investment. So I think, Neal, you well know you've never been in a better negotiating position with anybody. That means other companies, other countries, and other governments. I hope this government takes advantage of the base that you've got so that we can get some of that future investment.
Yeah, let me say that we'll certainly consider that, but I think primary and most of the questions we get now are really on capital allocation, and that's what's going to lead to the re-rating. So our primary focus is getting our gross debt down. So even though our net debt to EBITDA has come down, that's a mathematical calculation. We still need to get our absolute debt down, probably to about $1 billion. We're now a large company, so $1 billion is considered appropriate gearing. That's a primary focus. I think the next one is returning cash back to shareholders. You would see that we reinstated our dividend. In fact, the dividend could have been double what it is, but just coming out of COVID, we were conservative in an interim dividend. We also want to make sure that that the dividend is sustainable and growing in line with good commercial practices. But we want to get back to being that industry-leading dividend payer, and we do see how we can actually quite easily get back to a 5% dividend yield. Our earnings, if you look at let's take out the impact of COVID. There's no reason why this company can't generate 40 to 50 billion rand a year of EBITDA. That's at these current commodity prices. You use 25 to 35% of normalized earnings and return that back to shareholders. There will be a very significant re-rating. So we know how to improve the portfolio, the quality of the share and the premium. And then, of course, what do you do with excess cash? Well, we're not going to sit on it, and if we can't turn it to account and get a better bang for our shareholders buck, we should return it to shareholders. But of course, that's where you look at other value accretive strategies. Hopefully we can do some more smart things, counter-cyclical, but that's the order of priorities, and that's what we've been communicating. We continue to work on the South African government because we owe it to ourselves. There is a discount in our share price being a South African company, so it makes sense to engage. And in my view, we just have to engage harder with government. We are very actively involved in the discussions between business and government. But I must tell you, I am at a point where I see it as hopeless, because the ANC will implode if they do the right things, whether it's on corruption or whether it's on economic policy. And unfortunately, they seem to have taken a road that is, we'll stay in power and we'll destroy value over a longer period of time. And of course, at least we remain in power. It's not in the national interest. But we'll continue to fight that fight and try and convince and persuade.
Neal Froneman, thank you very much. We've overstayed our welcome slightly, but I'm sure that everybody who was here enjoyed it immensely. We thank you for your contribution today, Neal, and for sharing your views on the country. I would just give one small thing of hope. We do have a precedent about a political party in power acting in the national interest. That was F.W. de Klerk and the National Party, of course. So who knows? We might see a repeat of that. Miracles happen in this amazing country of ours. While we say goodbye to Neal, I'd love to get a view from the two of you. If you could just give us your views quickly on whether what you heard today made you feel that it's a stock that you'd like to be buying now, Sibanya, at these levels. Neal's talking about a 40 to 50 billion EBITDA per annum play. That's a heck of a lot of cash that's going into the government coffers in South Africa through taxes, not just directly through corporate income tax, but also through PAYE and VAT and a whole lot of other things. But your view, Peter, finishing with you.
Alec, I'm too much an historian, and I always try to plot where does the revenue come from. So I put all the components together where the revenue comes from in this company, and it's a real lamppost type formation. Their revenue in dollars has doubled in the last 14 months. And there is precedent. It did this about 10, 11, 12 years ago, and it did this about 30 years ago, and a little bit about 40 years ago. So each time though, it looked like a lamppost. So right now, I'm just too afraid of the underlying revenue factors to make me want to run in and buy this. But a policy or a good transaction will often cancel out a fall in revenue. So you don't want to sell everything, but these are real lamppost type formations that are holding this up. This is so unique, all these big PGM prices and gold going up together, that I'm wary this thing needs a break. And it's not the company, it's the underlying revenue base. It's the commodities.
That's a pass for now, David.
Yeah, this could continue for some time. I think as long as governments are issuing money, and there doesn't seem to be any suggestion that they're not going to do it for a long time. And also the big thing that we're hearing all the time is infrastructure projects, whether it's South Africa, whether it's United States, wherever we hear. So there could be something on the horizon. I'm a reluctant commodity buyer. I'm very, very narrowly exposed to to the industry. And strangely enough, in a small pension fund or in a small unit trust I run, I do have Sibanya. But I'm a big Neal Froneman supporter. I think he's got immense courage, immense. And you heard today, he tells it like it is. And I think the one message that we should get from this is, and I see it every day when I run in the roads, all the kids have got their AirPods in their things, and when you talk to them, they don't listen. And my message is that government should take out the AirPods, and just listen to someone like Neal, and to an extent to someone like Peter, who's got an immense understanding of the mining industry here, and is another person who tells it like it is. So I think this has been a classic show, Alec. Well done.
Thank you, David. Thank you, Peter. Just to remind you that that we're here every Monday at this time. We can't promise you as forthright a discussion as we've had today, but what we can promise you is that we will have the right people in the room to share with you. Before we leave, though, my colleague Stuart Lohman will just update us, and my sincere apologies. We had a heck of a lot of questions that we never got around to. I hope that most of them were answered through the discussion anyway, and to a large degree they were, apart from a few specifics that we'll have to just pass those on to Neal individually. Stu, where will we be able to pick this up later?
Excellent, thanks, Alec. It's great that we're not traditional radio, because we got a good extra 15 minutes there. I think it was a fantastic discussion, and thanks to everyone involved today. Alec, I've put the YouTube channel there on the chat bar, which is on the same control panel where people put their questions in. And we'll get that up, as you said, hopefully in the next couple of hours, as we do once it's been processed. But all good this side, Alec. Thanks.
And thanks again for joining us. Look forward to serving you again in the rest of the week, and of course, every Monday at noon for our Biznews Premium subscribers. Until the next time, I'm Alec Hogg. Cheerio. Thank you for joining us for this webinar, which is compiled and produced by the team at biznews.com. A recording of this webinar will be available later today on the biznews.com channel on YouTube. From our team, until the next time, cheerio.